If your financial strategy for this year relies on the Federal Reserve cutting interest rates, you are locking yourself out of the market. Waiting for rates to drop is a flawed and dangerous approach right now. Inflation is still running well above the target line. In fact, following their latest press briefing, the discussion among policymakers has shifted. They are now actively floating the potential for rate increases before the end of the year. For those of you sitting on the sidelines, holding off on a purchase or an investment, the clear, predictable path to lower borrowing costs has vanished. Trying to perfectly time your entry into the housing or investment market means handing over control of your timeline to unpredictable economic forces. You cannot build a solid foundation on guesswork. We are going to replace that guesswork with the Strategic Financing Action Plan. This is a methodical, two-phase framework designed to help you acquire assets today while systematically adjusting your costs down the road. Phase 1 secures the property before borrowing costs climb any higher. Phase 2 positions the structure of your loan so you can seamlessly transition to better terms later. Let's start right now. Grab a pen and a piece of paper and write down the specific target price of the property or the exact investment amount you want to secure. Putting that number on paper moves you from being a passive observer of the economy to an active planner. You are creating actionable momentum and neutralizing market anxiety. Step 1 is formalizing your commitment. You are going to move forward with your target purchase based strictly on today's conditions. Delaying this step exposes you to significant financial risk. Recent financial media reports confirm this, explicitly noting a growing openness among Federal Reserve officials to execute further rate hikes. This diagram shows the mathematical reality. Acting now secures your baseline cost. Waiting leaves you exposed to aggressive higher borrowing costs. Even if rates drop, a massive flood of sidelined buyers will immediately re-enter the market. That sudden surge creates intense competition. Bidding wars escalate, meaning you end up drastically overpaying for the asset or missing the opportunity altogether. Locking down the asset under current conditions eliminates these variables. You bypass the bidding wars and shield yourself from future market chaos. That brings us to step 2, securing your current term financing immediately. You need to get formally pre-approved and strictly lock in your rate based on today's actual numbers. Do not accept any floating rate offers. Run the calculations to verify that your finalized monthly budget is completely sustainable at this specific, elevated rate over the long term. If your survival depends on a rate drop that hasn't happened yet, you are risking foreclosure. Treat any future rate reduction as a mathematical bonus, not a requirement to keep the property. Now we move to step 3, optimizing your loan documents so you have the legal right to execute phase 2 down the road. You have to read the fine print. Some lenders will tempt you with slightly lower initial rates, but they do it by hiding restrictive clauses that punish you financially if you try to exit the loan early. Explicitly ask your lender to confirm the absence of financial penalties for early payoff. Get it in writing that there is no prepayment penalty. Next, check for a seasoning period. This is the mandatory waiting time a lender requires before they legally permit you to refinance the loan. Keep this window as short as possible. Accepting a fractionally higher initial interest rate on a flexible loan is vastly superior to being trapped in a restrictive contract when market conditions finally improve. Step 4 is setting up your safety net, mapping out the exact mathematical conditions required to activate phase 2. Look at your paper again. Write down a specific numeric target, like a full 1% drop from your current rate. This flowchart shows the logic. That single number defines your profitable refinance environment. With your number written down, open your phone and set recurring quarterly calendar reminders. Every 3 months, you will evaluate the current market. Triggers completely removes emotional hesitation. When the Fed eventually shifts its stance, you won't need to guess if the timing is right. The math will make the decision for you. You now have a complete framework. You know the exact steps to secure the asset today, the specific questions to ask your lender to demand flexibility, and the precise mathematical triggers to execute your refinance. This strategy gives you a powerful dual advantage. You are completely immune to immediate rate hikes and totally prepared to capitalize on future rate drops. Navigating these highly volatile economic periods requires you to replace your fear and hesitation with a rigid mathematical strategy. If you are ready to map out your specific scenario, reach out to me directly. We can customize this exact blueprint against your personal financial numbers. Long-term wealth is built by those who aggressively adapt to the market they have right now, rather than waiting on the sidelines for the market they are wishing for.